welcome to another investing edition of Business Talk with Wendy Myers, head of Securities at PSG Wealth. Wendy, I've just got to say up front, I'm really loving this series so far because the sense that I'm getting from viewers is that it's empowering them to start taking real ownership of their financial freedom. Now, I'm sure that must be music to your ears when you hear that kind of feedback.
Very much so, yeah. Thank you, Michael. It's lovely to hear.
Now, when I was at the investment forum this week, which is where the great and the good of the asset management industry gather once a year, one of the toughest questions for experienced asset managers is what we're discussing today. So if you're a retail investor, don't worry. Even the pros really grapple with this one. It's when to sell a stock and when to kind of cut your losses. And I know we spoke last week about the importance of not panic selling, but there does come a time when selling and kind of preventing further losses is imperative. And it is kind of part of a necessary toolkit in one's investment journey, and they're the right and the wrong reasons. So let's just look at the right reasons, the good reasons for selling, and when to sell a stock for a profit or a loss, and what are the circumstances that justify placing one or more sell orders.
Yeah. Yeah, thanks, Michael. I think for most investors, it's extremely hard to separate emotions when investing. Um, and I think, you need to remind yourself that the two sort of key emotions that drive an investor from a response perspective is when they're considering selling is greed and fear. And the ability to manage these emotions is, to me, really the key to becoming a successful investor. So I think maybe it's a good time to just think about how investors can act a bit more rationally when selling a stock. And I want to touch on a few guidelines that certainly I consider to be quite critical when you're looking at your portfolio and you're thinking, what can I do to take a bit of risk off the table? So I think it's important when you're looking at a stock in particular, to look at that stock and say to yourself, well, if I want to sell, why is that? And it's potentially because your investment outlook or investment strategy has changed. I think Lululemon and Mr. Price are very kind of topical stocks and good stocks to buy when you consider the retail market, thinking offshore and local. But maybe now in an environment where inflation is quite heightened, you actually think to yourself, I actually want to limit my exposure to retail. Or maybe something fundamental about the stock has changed. And that could drive a solid reason for selling. Perhaps their sales growth has slowed. Maybe the company strategy is going in a different direction and you're not in agreement with it.
Yeah.
The company's management has changed, or even the dividend policy has changed. And Michael, we talk a lot about the importance of being invested in strong companies with good dividend paying policies. Another good reason, in my opinion, is if the company has suddenly announced it's going to be acquired. And typically after an acquisition is announced, the share price of the company being acquired rises to the level of the agreed upon purchase price. And, there's often challenges post-acquisition. So often further upside is quite limited. So it's a good time to lock in your gains shortly after the announcement and look to see where else you can invest. Obviously, our constant discussion around rebalancing our portfolio to make sure your exposure across sectors is maintained in balance, because you want your balanced portfolio, obviously, and you want to maybe consider more ETFs or fixed income holdings. And then another classic example, which is, I think, one of the main reasons why investors look to sell a stock, is because the value of the stocks become too big in the consideration of your entire portfolio. I mean, think of Nvidia and what it's done over the last 6 months.
Yeah.
It's been dramatic in the last 5 years even. So it's a good time to take a bit of risk off the table. I think choosing that right time to sell is never easy. But I think what's important to do when you decide to sell, it's extremely important to make peace with the fact that you're giving up further equity upside. So be comfortable that if the share price goes up afterwards or comes down, it's okay. And you've taken your profit and you're going to sit on the sideline for a while and you're not going to have as much exposure to that particular stock.
NVIDIA is such a good example of that because I'm sure many would have just seen that meteoric rise and up to now the third biggest company in the world, but maybe sold 30, 40% ago because it had become so big in terms of the overall portfolio. And it comes back to earlier advice around ensuring that there's not too much concentration risk in your portfolio. And then you watch it go up even further and you think, oh no, did I sell too early? So you've got to be able to make peace with it. I think another important question, and I mean, those are all really good rational reasons to sell stocks, and they also just speak to the fundamentals of your investment plan and why you do things. And Exara was a great example recently of a stock that's a great dividend player, even though it's in the very volatile commodity space. And this leads to my next question on when not to sell a stock, because often, and you talk about greed and fear, but you look at a commodity stock, for example, and it goes through these cycles, and maybe there's the right time in the cycle to acquire a commodity counter versus when to let it go. But when is it not the right time to sell a stock? When are the reasons the wrong reasons?
Yeah. Well, I think to your point, Michael, don't sell because the price has gone up. You know, typically winning stocks continue on that trajectory, and you want to participate in that. So just because it's gone up 15%, don't think, okay, well, I'm gonna bank my profit now. I think keep remembering that you're in it for the long term. Um, and then the counter argument to that is don't sell a stock just because the price has gone down. Investors, I think they think that, well, it's gone down, it's going to stay down, and that's it. I think critically look at each company and decide on their strategy, are you comfortable with it, the fact that it's in the right direction, the management is good, and you believe in the long-term success of the company. But I think it's important to ask yourself the following questions. If the stock is trading at low levels, is it a consequence of the wider market, so the same industry seeing similar dips, or has something happened specific to that company? Maybe something's in the news, it's a bit topical, maybe there's a tax issue, and that's a once-off. As the company deals with whatever it is that's in the news at the moment, the stock price will recover. Has the company performed this way before and recovered, or maybe not? So look at past history to see the
Yeah.
success of the company. And what does the competition look like? What have they done from a share price perspective? Are they also down? And maybe do a bit of research and find out, like, what is the reason for that? And I think the overarching consideration, I always think of Warren Buffett and what he would think, and his favorite holding period is typically holding a stock forever, which I love.
Yeah.
But even he is someone that says there are definitely valid reasons for selling a stock, and it's important to make peace with what those are in your mind. And then when there's a need to act on it, that you do that.
It reminds me of another famous saying. I think it was Milton Friedman who said, when the facts change, I often consider the new facts. And if it means I need to change my mind, that's what I do. And it's just a question of being pragmatic and realistic, that you go in, if you're buying a stock for the right reasons, you're buying into the theme, the narrative of the company, the management, as you said earlier. But if something changes in the market, maybe there's a huge competitive shift, and all of a sudden what looked like a sure thing in Kodak, you realize now is a company that didn't innovate fast enough, and that's okay. You then you sell out and you reposition. What considerations should investors keep in mind when they're contemplating selling shares?
Yeah, well, I think the overarching one for me is make sure when you're selling the shares that you're doing so in the context of your financial plan. That must guide you on what you're doing, why you're doing it, and what your next steps are. And it needs to be that you're selling the stock for a certain particular outcome within the context of those short-term and long-term financial goals. Think about how you're going to invest the proceeds of the sale. Does that mean you're going to park the funds in cash for a bit, and make sure that whatever platform you use, you're earning money on those funds, because it's going to impact the performance of your portfolio until you decide to re-enter the market. Consider, is your decision to be out of the market because you're de-risking? So think of what other products you wish to invest in. I spoke earlier about fixed income and maybe buying ETFs, which offer you that rebalancing within that single counter. Or are you taking a step back for a period of time? Nothing wrong with that. And then you want to re-enter the same stocks you've sold, even at a predefined entry level in the future. That's absolutely fine as well. But I think be mindful of timing the market. It's very difficult for investors to be disciplined and to buy back at the right time. We all want that crystal ball. I've spoken about it often.
Yeah.
And sometimes it's actually best to say, well, I can't time the market. So actually, I'm going to sit out for a period of time until I'm ready and my headspace is right. And then I'm going to buy in irrespective of what those entry levels are. And I think the final consideration, Michael, is definitely tax. So remember that you'll trigger a CTT event on the sale. So make sure you've got enough cash to fund that when it's time to settle with SARS. And also remember that the interest income that you're going to earn on the cash is going to be tax at marginal rates, and that's obviously at higher rates greater than CGT. So that's an
Yeah.
important consideration when selling. And I think just for me, the bottom line is, as an investor, remember selling is fine. Do it for the right reasons, and sell because the company has fundamentally changed, so it doesn't align with your financial plan, and because you can deploy your money more effectively elsewhere. Don't just sell because everyone else is selling,
Yeah.
and don't just sell to lock in a quick profit because you could have been potentially made more if you'd stayed invested.
No, very good points you've raised there. And it was a great example at the investment forum that a fund manager shared around Fortress and what happened when Fortress was in the news for various interesting and curious structures and holdings in subsidiaries that were effectively round tripping and buying back into Fortress. And I mean, the share price went through a torrid time. They sold out, but then there became this issue between the FFAs and the FFBs, and it was clear that there was going to be a value unlock when the share structure and the capital structure of the company was sorted out, which happened. So then they got back in a couple of years later. So even within a single counter, the investment thesis can change over time, but you've got to be doing it for the sound reasons that you've just mentioned. When it comes to all of this, for a retail investor, I think it can really become quite complicated. And I know financial markets always sound complicated, and when we talk about them, they sound so simple. Maybe that's just your skill, Wendy. But how do financial advisors assist you when deciding on when to exit a share? What role do they play here?
Yeah, look, they play, to me, an extremely important role. I think they will always make sure that you're rational. I think they can guide you in making sure that your transaction is objective, and it isn't a panic sell. I've always said advisors need advisors. Investors need financial advisors, assisting you in deciding whether to sell the full holding, maybe even just a portion. And I quite like that, actually, Michael, because to me, it gives you the ability to take a bit of risk off, but still have equity upside in that particular counter.
Yeah.
Maybe your advisor will guide you as to the consequences of the sale from a tax perspective. Remember that they can't give tax advice, but they will be able to guide you holistically from a tax perspective. And then they can certainly, and this is an important role for them, is to guide you into your next investment decision. And that needs to be done in the context of your predefined investment goals and risk profile. And then make sure that your overall portfolio remains balanced. And remind you, I think that's also an important part of the investor, that the financial advisor can guide you on, is reminding you of your goals and why selling in this context is the right thing for you to achieve those long-term goals.
Yeah. Yeah. I mean, you mentioned the fear and greed emotional response that drives our behavior earlier on. And I think that's almost the most critical thing because they are powerful, powerful emotional driving forces. And so to have a third party kind of just validate our decision making, hold a mirror up, remind you of why you're doing what you're doing, I think it just helps kind of draw that sting of emotion out of the decision to ensure you're making the right decision, the rational decision. And as you say, the bottom line is, selling is fine. Everyone does it. But if you do it for the right reasons that we've just mentioned. Wendy Myers, thank you so much, Head of Securities at PSG Wealth, as always, giving great advice here on Business Talk. Take care.
Thank you, Michael.